Hello and welcome to ET OnSite, a show where we get you companies that would be tomorrow's large caps. I'm Neeraj Shah. What differentiates M&M Financial Services from its peers is its strong rural penetration, diversified product portfolio and strong return ratios. Consistent growth of 25% a year in assets under management, stable asset quality and the Mahindra Lineage are reasons why the stock trades at a premium to other NBFCs. We caught up with Ramesh Iyer, the company's managing director, to find out if it can replicate its stellar performance of the last 5 years over the next 5. Let's listen in. So Ramesh, multiple businesses, 2 or 3 of them. Let's talk about the largest one, the vehicle finance business. And 2013 or FY13, there was a fall of 5 to 10% in auto sales as per the SIAM data. You still showed fairly robust growth. What do you do in 2014 or FY14?
See, one is, what started off as a kind of a single product company. Today it's a multi-product company. And therefore, for us, little of more. That's going to be our story. It's not more of one thing.
Yeah.
So we're going to do all vehicles, tractors, second-hand vehicle. That's still a long way to go in my opinion. I mean, if you look at our market shares, clearly yes, in Mahindra and Maruti are 2 matured business of ours in the balance sheet. But then you look at many more product, I think we have a small little market share because the product is just entering those market. And I think all of them have ambitious plans for growth in that market. And I think we'll be one of the key enablers to ensure that we are able to contribute well.
Yeah, but what kind of growth comes in? Because, I mean, if I'm not wrong, there are reports which say that your disbursements could actually dip in FY14 compared to what you did even in FY13, and the pickup would start post FY14 into FY15 and onwards. Is that a reasonable estimate?
I'm not too sure. Why should the disbursements really dip if we actually increase our market share? Right, and I am also kind of in a way estimating that last 2 years, if you see when the growth was good, it was largely contributed also by a very strong cash purchase percentages. Right, and therefore you would see that the overall volumes that's available for financing to NBFC or a bank is going to in fact go up even though the overall volume may not go. And then the second is definitely we do expect that clearly there will be some price increase that will happen to these vehicles. And therefore there are price increases will also contribute to growth of an NBFC disbursements clearly. So I'm not overly concerned or worried about is the volumes really coming down. I think it's all about how well placed are you, and then we are increasing our penetration. And therefore we will broad base.
So in fact that was going to be my question. If under penetration is the nature of these beasts, the reason why this business is thriving, I mean, I looked at the penetration level figures. There is a minuscule percentage which has been penetrated till now. Are you saying that such kind of growth, even though the base may be large, would probably continue for the next 5, 10, 15 years?
I think a finance provider, a credit provider must have the capability to expand the market. If you're going to participate what the market is and then you try to get market share out of that, I think one will start talking of if the market shrinks, will you also shrink? But as a credit provider, if you actually expand the market, able to bring in more customer into the fold who through credit will get excited to acquire products, I think that's going to be the growth story.
Okay.
Right, and we have this 2.5 million customers spread in 170,000 villages, and we are only trying to expand our reach into more villages. I think through our customers we can reach out to many more customers who then will show interest to buy, and I think we have the role to play in expanding the market, and that's going to be our growth.
And does this come at the cost of net interest margins? My question simply is this, that look at the next 5 years. If you have to compromise your margins for getting growth, would you do that? Or do you think that there won't be a time like this? You'll be able to expand business and maintain the net interest margins?
We are very clear, we are a highly profit-oriented company.
Okay.
If the risk and cost cannot be passed on to customer, I'm not too sure it makes a big commercial sense to be in that business. So we actually go bottom up to say, what's the minimum margin that you want to protect? What's the cost at which you will run this business? What's the risk of this business in terms of its quality is concerned? Net interest margin is nothing but your lending rate and your ability to borrow. If you're a well-rated company, we get one of the best borrowing costs. right? And therefore there is an average yield at which the product mix comes in. I don't see a reason why we can't be protecting our margins.
No, the reason I also asked this question was that a lot of people penciled in better margins for you this year because everybody believed that rates would fall. Now, over the last few days with all that's happening, the belief is that, hey, maybe that may not happen. And in fact, if things worsen, then the rates may go up too. Do you still maintain your NIMs for FY14?
I think we've not factored falling interest rate in our NIMs when we have put out our numbers.
Okay.
If we were on record saying if the borrowing cost had to come down, it would possibly improve our margin over what it is.
Okay.
And we've said that in the past. And I'm still hopeful, and I was always expecting rain or rate will fall. The rains have. Let's hope the rates will.
Okay, that's well said. The other set of businesses, rural housing finance or the insurance broking business, they are the nascent state, so to say, for you as a company, if not for the industry. How do you think they will shape up in the overall umbrella?
I must tell you that both of these businesses have a phenomenal capability to contribute into the growth of our overall financial services sector that we run. Both of these businesses strategically will continue to focus in the rural market. And I think more than me saying it, if you were to talk to the CEOs of this business, you will see the passion with which we are growing this business. And we see a great future for it.
Okay, I think we have both of them here. Gentlemen, thanks so much for being a part of this show. Anuj, let's start talking about the rural housing finance business first. I mean, we are in a place aptly where you probably finance some of these houses as
Absolutely.
well. How do you see this business growing? And you've grown at a breakneck speed.
Yeah.
How do you see this business growing over the next 2-3 years?
We are on record. Ramesh has also made this statement repeatedly. We want to be a $1 billion balance sheet by the year 2050. And I think we are going to be there.
You may want to revise that with the dollar rates, but you still think...
We've said that. I said we've changed it to rupee.
So you would stick to what, 4,000, 4,500
Around
crores?
4,000, 4,500 is what we are looking at. We are currently at about 1,000 crores, and I think we should get there. Because in this business, what is really important is word of mouth. If you have a certain critical customer base, which is happy with you, which we think our customer base is, I think growing on that, on the strength of that customer base is reasonably easy. And that's what makes us very confident that we should be able to hit that level.
So that's 100% CAGR
over the next
year over year of the next 3 years. Beyond that?
Beyond that, I personally think we should be able to continue to grow at that rate, or maybe not at 100%, but very close to that kind of rate for the foreseeable future. Because if you look at it, we are talking about 6.5 lakh villages in this country. Today, MFSL itself is in about 2 lakhs, slightly less than 2 lakhs. We are only in about 19,000 villages. So we've got a hell of a lot of ground to cover, and I think we can get there.
Okay. Jaideep, what about the insurance broking business? I mean, it's a nascent business of sorts for the industry at large too. How do you think things will shape up for MMFSL?
Yeah, in fact, for us, this is like very synergistic with the main business of Mahindra Finance, which lends money. We have a business which protects this money. So the customer of the rural markets get a protection for the life with a product which we call Loan Suraksha. We also protect the asset of the person, which is the wealth, because without that they will not be able to generate revenue. And the third part which we have recently introduced is the Arogya Suraksha, which is the health. So we're looking at the health, wealth and the life of the customer. So I think that having said, our target is that this is a nascent industry. We would also like to be, as what Anuj said, same kind of aspiration, but our aspiration is for 2020. We would like to touch a 1 billion kind of a premium which we could generate from this industry.
Okay. Ramesh, you had something to add to that?
Yeah, basically if you kind of look at all three businesses of ours, it's built on the RISE philosophy. That's the group philosophy which all of us are driving. Clearly, we don't accept any limits. People say rural is CSR. We said, no, that's a business model.
Okay.
Right. We always keep doing alternate thinking. We say, what else can we do? How else can we do it? At the end of the day, it must matter to the customer. It must be a win-win solution for all of them. I think we put this together, and that's what we drive this business. And that's exciting to us.
Okay. Speaking of customers, as we head into the break, here are one very happy customer of Mahindra Financial Services Limited. He's probably taken a couple of products from MMFSL and he's very happy about it.
मेरा पास तो पहला कुछ नहीं था. मैं महिंद्रा फाइनेंस से लोन लिया, उसके बाद मैं एक ट्रैक्टर लिया. ट्रैक्टर से मेरा मैं कुटुंब चलाता है. वैसे काम करके अभी थोड़ा टाइम से मेरा मकान भी बढ़ाया और अभी मेरा से नाम आदमी लोग पूछता है तो उससे क्या करें तो मैं महिंद्रा से फाइनेंस से लोन लिया, उससे मेरा अच्छे चल रहा है.
They may participate and still
So Ramesh, we've discussed about your different business aspects. Now, just tell us as to how do the next 4-5 years of the company look like in terms of expansion. I believe you've around 650 odd branches currently.
That's right.
How do you expand over the next 2 to 3 years? One, the nature of the expansion, and two, the number of branches that you open.
See, one is very clear. We still see rural. There's huge opportunity for us. When we started off, we didn't imagine that this is the size of opportunity.
Okay.
But as we speak today, I'm very confident that the opportunity is much, much larger. It's not just vehicle financing, tractor financing, second-hand vehicle financing, which of course is expanding. But I think it's even more important to look at, we have a housing venture. That's again focused only in rural. We have the insurance distribution that's focused in rural. So we believe that, each of this product, we've looked at the SME segment as one possibility. Where there are small units around who look for this kind of a capital support, working capital requirement. I think put all of this together, I would think that's the size of the opportunity. But then how do you reach them? Right? We started off opening branches. Initially, if you look at us, we started with district headquarters. We moved to the taluka levels. Today we are talking of wanting to open actually branches in villages, right? And we want to cover the villages. If you look at the village clusters, you look at a taluka covers about 60-80 villages.
Okay.
Right? So we now sitting in talukas and covering villages around, we cover about 170,000 villages today. And if you look at 6 lakhs villages in the country, give or take some numbers, which may not be economically very viable, but I still think there is so much more that we can do going deeper into the villages. And that's where our growth story is going to be. That's where our participation is going to be. We in fact are recruiting people from these markets.
Yeah, which you told me about. So in terms of number of branches, say for example you're at 650 or 700 as the number may be.
That's right.
Do you expand at 10-15% annually? And how do you fund these expansions?
See, typically if you look at every year, let's look at the last 5, 7, 10 years, we've been adding about 10% of the basic numbers, about 65 branches per year. We've now, as I told you, cover about 170,000 villages. Suppose we were to take a number for ourselves, next 5 years we want to cover another 1.5 lakh villages. That would actually mean we need to open another 1,000 branch.
Okay.
Right? And therefore you will see the expansion rate a little more faster than it was. But it'll still be about 80-100 branches that we may open a year. That's the way we will progress in.
So you do not require any kind of equity money over the next 2 years at least. You've done a QIP which was very successful in November 2012.
That's right.
For the next 2 years, if not the next 5, do you foresee any equity fundraising?
See, typically we raise equity only for our, growth capital. We really don't raise equity for this kind of capital expenditure.
Right.
So, and we've kind of set for ourselves almost every year that once in 2 years we do access the capital market. 2006 we did our listing. 2008 we did the first raising, after that 2010, and now we did 2012.
So 2014.
So it's typically you look at our growth story, we maintain 30-35% growth over the last 10-15 years that you've seen us. And that requires that every 2 years we raise capital. And we want to always stay a little higher than the normal capital adequacy norms that's been prescribed. Sure. So if you have to maintain that, that needs us to come to the capital market once in 2 years.
So, so my question really is, your NPL levels were in the range of 1:3 if I'm not wrong till 2010.
Right. That's right.
You brought it down to what, 0.6 to 1 or thereabouts.
Yeah.
Is the aim, I'm guessing the aim is to take it more lower, but do you think it's realistic to bring your NPL levels even lower over the next 3 years?
See,
than where they are right now?
If you kind of look at NPL is still a regulatory requirement, right? What we measure ourselves is by the credit loss.
Sure.
So historically, I would like you to, go back to 2008-9 period, and the NPLs actually had gone very high to 10 and 11%.
Yes.
But those days we were a single product company, very farm oriented. Poor monsoon got us to a situation where the yields were low, and therefore the NPLs went up. But believe me, the credit losses never went beyond 1.6. So if you kind of look at our entire approach to this business is on credit loss basis. Regulatory change will tomorrow make the NPL 90-day provision.
Which is my point.
Yeah.
Usha committee recommendations.
And we are very happy about it. It's fine that if that's a regulator's requirement, there must be a underlying fundamental reason for doing that. But that brings that much more focus on the organization to make sure that you start concentrating on these accounts very closely.
Right.
But the truth still remains that in a collateral-backed lending, the asset must protect the principal.
Right.
And we have not seen historically our credit losses ever climb beyond that 1.4, 1.6 levels.
And you think they'll stay that way?
I think it'll stay there.
For the next 5 years?
I think so. Because if you don't do anything silly, you don't give 95% loan, 100% loan, you never get to that situation. Because somebody who's investing 25-30% has also got the responsibility to make sure that he runs the assets well, he maintains the assets well. I think this very interesting feature one to understand. Most of those guys who buy this vehicle, they do look at the resale price of this vehicle. So therefore, if they maintain a vehicle extremely well, they want to make sure that the end of the loan, right, when they sell the vehicle, they're able to get adequate fund, which actually makes them bring margin money for 2 vehicles. That's how they graduate to becoming a fleet operator.
Okay.
That's a fundamental with which they run that business.
Great. So, okay, last couple of questions really. One is on, it may well be an accounting thing, but if indeed the Usha Thorat committee recommendations are put into place, does that dampen the picture of even for that little intermediate period, if indeed it moves from the current norms to 90 days? Does it impact you?
One is it's talking of from current to 120, then moving to 90 by 2016, right? By the time 2016, this balance sheet would have fairly run off.
Okay.
Because, it's already 1-year-old balance sheet and whatever. Therefore, you need to fundamentally be ready with a process for any new asset that you'll raise over a period of time.
Okay.
What we've also done is we moved ourselves from 180 to 150 already.
Yes, you have.
Right, so we moved one step. Maybe over a period of time, we'll review ourselves and see where we need to move even more closer.
Okay.
Right, but I strongly think that this balance sheet would run off largely by the time the 90 days comes in. And therefore, the new assets would be well provided for on that basis.
Okay.
So we don't see the balance sheet really going through that kind of a cycle. The current balance sheet not going through that. But there'll be a preparedness for it.
Stay on, Ramesh. Lots more to talk about. Let's take that very quick break. Hear out a voice which is bullish on Mahindra Financial Services Limited.
We like Mahindra Finance as a story simply because it has evolved in a large way over the last 20 years since it has been in existence. It started off as a captive financier for Mahindra and Mahindra Group and has since now diversified its portfolio mix to finance a lot of other brands. Going forward, we feel that given the rural disposable income going to increase on account of government projects in the rural area increasing and minimum support prices sustaining at high levels, we feel that the rural disposable income will increase over the next couple of years and will continue to drive Mahindra Finance's loan book growth over the next 2-3 years. We expect healthy growth to continue for the NBFC.
Mahindra Finance is one of the top quality players in rural India. If I look top down from a macro perspective, rural India at this point is doing far more better than urban India. And in longer duration also, we expect rural to do pretty well. Given the structural changes in rural India with more infrastructure coming up, with government spending in rural India, and hence we expect rural economy to do pretty well. At the same time, we find Mahindra as the top quality player in rural financing, given they have mastered the art of rural financing with their business model. And because of all these reasons, we expect Mahindra Finance to grow at more than 20% rate for at least a couple of years with an ROE of around 20%. And hence, this is one of our top picks in financing space.
Not that you don't enjoy, of course,
Oh yes, indeed.
That's the way it is.
So, Ramesh, coming to the final set of questions really, and let's talk about the next 5 years. You've had a very good credit growth period from 2008 to 2013 as of now. How do you see the next 2 years and possibly the next 5 years?
See, as I started off by saying, the opportunity size is enormous. Even though we think, we've grown well, kind of superimpose this on the overall rural opportunity, we still think that we've done something very small. That's what our belief is. Look at now most of the manufacturers trying to enter this market. Look at the aspiration levels of rural India. They are all looking for more products. Look at the capability of all these guys to be able to bring in some initial cash to be able to buy assets. The multiple cash flow that's happened in the rural market, when we started in 95, at least we thought, was a very farm dependent cash flow. Today as we speak, we have gone into multiple cash streams. Could be because of contracting, could be because of trading, right? And we clearly see, we did a small survey, and that tells us that at the local level, the aspiration is education, health, shelter, These are the aspiration. So we do see a role for us in all of this. Like our rural housing will be a great story to watch in my opinion. Okay. Believe me, it will be a great story to watch. Okay. Apart from, the vehicle, the way we have done it. When we got in, we also thought it's a difficult business. But I think that's a business if you understand the customer requirement and then you design product that suits them extremely well. Sure. I think that's a very, very doable big business. Okay. Likewise, insurance, we're taking insurance to that market, I believe. Not so much has gone in. It may not build a balance sheet, but it has the capability to bring down your overall cost of operation. So if you kind of superimpose all of this in little of what we are doing, I don't think we have ever expressed, nor do I want to, that there is any fear of will the asset side show this kind of growth. I don't think so. I mean, even today, if you're growing at 30-35% that we've done in the last 4-5 years, is by design. If we add more branches, we add more people, kind of go more deeper, much faster, maybe the growth could have been faster. Sure. But I think we want to do it as much as we believe is correctly we can handle. Don't mess around with quality. There's no urgency to kind of, accelerate the growth. Sure. And therefore, I don't think we are ever expressing there is a big issue on the asset side.
So asset quality remains stable for the next 5 years?
I would think so. I mean, if you don't do anything silly, don't do increasing LTV unnecessarily, don't kind of run a mismatch of ALM and give a 5-7 year loan for no purpose. If you don't do any of those and you continue to understand the customer cash flow and design products around that by taking people locally who understand the local culture, local nuances extremely well, I think it's a doable business.
And despite all of this, despite the asset quality being stable, despite NPLs what they are, or the credit cost being what they are, you would still grow at 30-35% for the next 5 years?
I mean, I'm not putting a number of 30 or 35. I am repeating to say I think so. There's no challenge on the asset side for growth.
Okay, great. The other interesting bit is, before I come to some other numbers, is that you've done some key partnerships. I think the last one that I also read about was the Toyota Kirloskar one. And a lot of people believe that this will be the key for you, forging key alliances with OEMs or car companies, and that will take the growth further. Is that something that you're consciously targeting? One, are more announcements of such nature in the offing over the next 12 months to 18 months to 24 months?
I mean, if you kind of look at it, we may want to call it as an alliance or a partnership or whatever. But effectively, what are we doing? We are actually kind of building a channel around and making it available to almost all the manufacturers who may want to look at that market for their growth. So the fundamental is this market should be of their interest.
Sure.
Okay, then it works. Two is, I think we are trying to meet the customer request, customer requirement, aspiration through this channel. And therefore, in this direction, if any manufacturer wants to utilize our services going as deep there, I think we are available.
Okay. The other bit, Ramesh, that I was wanting to ask you was about how do you think your return ratios shape up? I mean, return on assets, ROE, it's been very stable. I think for the last 5 years, I don't think it's deviated too much. You think you stick to those ratios for the next 3 to 5 years? Is that a conscious effort that you'll put in?
We've always said this, that we want to be in a business which gives us at least 2.5-3% return on asset. And as I started off by saying, we don't leverage beyond 5.5-6 times. So therefore, maintaining that kind of a ratio, if we bring down the operating cost, if we maintain the quality of asset well, I think maintaining this ratio is not a challenge, because at the end of the day, the larger cost of this balance sheet is the cost of borrowing.
Sure.
Okay, that's so market driven.
Yes.
Right. The next two cost is the operating cost and the quality, the NPLs. Right. Those two are very much in our control in the sense of how do you run your business. So we are making a large investment in terms of infrastructure in the sense of IT. And therefore, I believe the transaction cost is likely to come down if you were to shift many of the physical transaction to an IT platform, which is doable, right? And therefore, the transaction cost is likely to come down. Two is, I think, building people capability is another very, very important issue. And as a single product company operating from a limited branch, there's one set of competence required. But as you move into multi-product, then the understanding of the customer cash flows for various applications becomes that much more important. So I think people capability will also ensure that asset quality is well maintained and also efficiency in transaction comes in. I think if these two are done well, I think there should be no reason why one can't maintain this kind of return.
So ROA of 4%, ROE of 24%, you think both of these stay?
At least 3 ROA is definitely doable if this is structured extremely well this way.
Okay, great. The net profit growth has been robust for you, if anything. I mean, 38% consistently since I have tracked this company as well. With all the pressures that are there around the business, you think this northwards of 35% PAT growth is sustainable?
Again, it comes from where? It does not come from a very abnormal lending rate. I think it comes from a very, very high quality asset being maintained. So when we factor in our price a 3% NPL and you end up with a 1% NPL, that's the additional 2%.
Right.
Okay, that's what gets you that higher return. And I think that's doable.
Okay.
You don't have to be abnormal in any of the parameters to maintain this kind of a growth. You know, the productivity of people over a period of experience does go up, but also multi-product from every branch also has gone up. I mean, we set up a branch to do a single product. Today from the same branch, if you're kind of let out many more products, right, I think the cost does come down.
So I'm taking that as a yes. You believe a 35%, northwards of 35% net profit growth is sustainable?
If you don't do anything silly, I don't have any reasons to kind of tell you otherwise.
Okay. And it's been a good dividend payout ratio as well from your company. I mean, 25% is something that you maintain. You think you'll maintain?
That would remain. That would remain.
Thank you so much for having us in such wonderful settings, in the fields, with the rural houses and everywhere. It was really a pleasure doing this show, Ramesh. Thanks so much. And
Thank you so much, and I always appreciate people who come to this setting to understand what we do, because more than explaining, you see it for yourself what we do.
Oh yes, and we've shown it to our viewers as well. Thank you so much, Ramesh. Thanks so much for having us.
Thank you.
That's M&M Financial for you. They've had a robust growth for the last few years, and the management is fairly confident of replicating that, if not bettering that, over the course of the next 3 to 5 years as well. Thanks so much for watching this show.